If you're investing in the markets, the thought of making money when a stock or ETF rises should be second nature. You may even be aware that you can make money when markets go down by having a short position in the underlying stock or ETF. But the rules around that can be complicated. Capital requirements can be substantial, and the strategy itself carries with it unlimited risk. Another way to benefit when markets go down is with a limited risk option strategy called a long put. Generally speaking, being long something means you own it and will benefit from an increase in its market price. Naturally, when you're long stock, you'll make money when the stock moves up in price. However, if you're long a put option on a stock, when a stock drops, the put on that stock should rise in value because of its inverse correlation to stock price. Like a seesaw, as the stock price goes down, the put value generally goes up. Long options in general are a common way to express your opinion on the direction of a stock or ETF known as the underlying asset. When you buy a put option, you're buying the right to sell the underlying at a set price, called the strike price, for a limited length of time. For example, let's say XYZ is trading at $51, and you buy a 45-day put option with a 50 strike price for $2.10. What this means is that you have locked in a potential sale price for 100 shares of XYZ at $50 for 45 days, no matter how low XYZ may drop. Your total risk when you buy an option is what you paid for it. In this case, $210 per contract buys you the right to sell the stock at $50, should you decide to exercise the put, and you don't technically have to own any shares of XYZ to own the put. But if the stock drops below $50, then this right to sell XYZ shares at the fixed strike price of $50 would make sense, because the put option is now in the money. In this case, many investors choose to sell the put for a profit rather than exercise it and take a short position in the underlying. Let's say that after a period of about 3 weeks, XYZ has sold off about 10% to $46. If the market is valuing the put option for $5.50, you have the opportunity to sell it for a profit of $3.40, which is $5.50 minus $2.10, the price you paid for the option. Keep in mind that if the stock had rallied, your put would have likely lost value, but because its extrinsic value is comprised of some amount of time value, it is unlikely that it would lose all of its value before expiration. Remember, like a seesaw, the stock price and the put value generally move in opposite directions. If before expiration XYZ moves higher, the value of the put generally moves lower. This doesn't necessarily mean you have a complete loss. The put option only loses some of the premium, but not all. How much depends on how much XYZ rises and how much time there is left to expiration. Only at expiration would the option be worthless if XYZ were equal to or higher than the strike price of $50. It's good to know that during the life of the option, the most you can lose is what you paid, or the $210 per contract. At expiration, if XYZ is below the 50 strike price, the option can be exercised by the directions because of their inverse correlation. Otherwise, the option can be exercised on your behalf by your broker in a process known as exercise by exception. If you want to avoid expiration risk or managing expiration costs or operational risks, simply sell to close your long put before it expires. Be aware that it might help to sell your put option prior to expiration if it looks like it might finish out of the money to avoid a total loss. To learn more about the long put and other strategies, visit the OIC website, optionseducation.org.